Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome back to the show. Today we have a special guest, and that is Lloyd Wertheimer. Lloyd joins us to give us a pulse on the commercial real estate market. A lot has happened in the last few months, and now that the presidential election has been decided, all eyes are looking at the economy and what's going to happen next with the recovery in the commercial space. Lloyd, welcome to the show.
Andrew, thank you very much. It's great to be here.
Well, let's kick right off and dive into the hot topics. What are you seeing out there in the marketplace? And for listeners that are either investing in the commercial space or considering doing some transactions, what advice or what direction can you send them?
Well, I guess probably the newest and most recent and exciting thing in the market is a post-election jump in the stock market. I think it went up 1,508 points after the election, and Trump was nominated or had won the election for president. So that sends a positive note to the economy, and I think we're going to see more of that. Even before that, we were looking at companies like JLL and CBRE talking about how their leasing is surging and how sales and transactions are starting to increase. And we're going to look for a lot more of that throughout the country.
I agree with you. I think 2025 and 2026 have bright horizons ahead. I believe we'll see transaction volume return. I know that office space has been a hot topic over these last few years because there's been so many people working at home. I anticipate people coming back to work. Is that the same thing you're seeing?
That is the same thing I'm seeing. Amazon is the most recent to put out there, either come back to the office or find a new job to their employees. And there's other companies out there that are doing the same thing. There's a company called Simon who are building more office spaces in Texas right now, and we're also seeing the in other parts of the country, New York, Florida, Los Angeles, San Diego, where office space activity has increased dramatically, and vacancy is lowering to a point that the rates are starting to go back up again.
Yeah, it's very interesting because one of our previous episodes, we discussed the Federal Reserve and the reversal in policy. And that was in the middle of September. And the market's reaction initially was that the rates dropped and that stimulated significant activity. But because the stock market has been so hot, rates have actually crept back up. So over this last 30 to 45 days, we've actually seen transaction volume diminish a bit in sales because the rates returned to nearly those all-time highs that we've seen recently as far as mortgages and financing. However, that reversal in Fed policy, I believe, was a reversal from headwinds to tailwinds for our industry at large. And now that we have a serious businessman in the presidential seat, I believe we're going to see a lot of momentum. And that's why we saw the stock market react the way it did. We have the Federal Reserve speaking later this week, and we anticipate that second rate cut and more liquidity coming into the market. So that's all positive. Now, what else are you seeing as far as the overall space in commercial? There was certainly, a dip, and those cap rates got affected when the interest rates went up. But in general, have you seen the effect on the West Coast, throughout the nation? What are the specific pockets you have your eye on and where you've seen the most opportunity?
Well, I think the most opportunity is going to be Texas still, because businesses are moving there at a pace accelerated from the COVID period. Texas is giving all types of incentives for business too. Los Angeles is starting to pick up in office, and Hollywood, Cushman Wakefield has reported a surge in leasing in a turning point. But office spaces in Los Angeles, along with mixed use, so you're putting retail and instead of residential on top, a lot of times now they're just doing retail on the bottom and the office on top.
Yeah, let's give people context so that they understand your history. Why don't you share a little bit about your background? I know you because you've been an incredible mentor within our company and you've helped so many agents. You have a wealth of knowledge. We happen to be alumni from a school up in the San Francisco Bay Area called De La Salle. So we're kindred spirits, but share your business background so the listeners have context.
Before I got into commercial real estate, I was with a company called W. Granger, and all my life I've been in business to business, whether it's with Granger. Before that, it was in distribution in another industry. And then in '02, I decided I wanted to get into commercial real estate, and I started out just walking the streets, so to speak, like everyone else does, and started with a small local property management company and moved up to a little bit larger regional and ended up with Lee and Associates before I went out on my own in 2014. I have my own brokerage firm. I've been doing lease negotiations and site selections for franchisees all throughout the country since then, and getting together with ARE gave me an opportunity to do something that I've done all my life, and that's share my time and knowledge with other people, whether it was being a coach in high school or doing mentoring for Rotary and RILA youth programs.
Well, it's awesome. And we appreciate your heart and the willingness to share that wisdom and knowledge and impart that wisdom in others. It's very much appreciated. I speak from a lot of people who have benefited from your knowledge. And I wanted to mention on your background, W. Granger, one of my favorite stocks of all time. And just for listeners that want to look it up, if you were to have invested in W. Granger, stock ticker GWW, in 1984, and today, here we are, 40 years later, your return would have been 140x. Yeah, 140 times your money. A great company indeed, and a stock that continues just to outperform again and again. Well, tell us a little bit more about the franchising. You represent franchises that are scaling across the US. And for listeners that either own franchises, considering to buy franchises, this space is critical, right? The location of the space and the site selection, et cetera. But just go a little bit deeper about how you help those franchisees and at what stage do you help them scale out?
Well, we provide information on helping the franchisor already has the demographics down of what they want and knows works the best. So we not only look for locations based on where they are on the street, so to speak, but also what the demographics are behind them. And then we present them with locations that fit the population, fit the household income. And then we go to the streets and tour the spaces. And then when they find one that they like and think this is where their business will be successful, we enter into negotiations with the agency that represents the landlord, and knock on wood, we get them the best lease we can for their next 5 to 10 years, depending on how long they enter into it. A lot of franchises they sign deals for 10 years, so the leases we try to coincide the lease with the length of the franchise agreement.
It's excellent. And who are some of the clients that you've represented? Maybe some brands people might be familiar with.
Good question. Raw Fitness, which is a boot camp type fitness program. The other one would be the Camp, which is another fitness. Brain Balance, which is schools for private schools in shopping centers for tutoring and such. I'm working now with a place called Water's Edge Winery, which opens up a winery bistro type location for 4,500 to 7,000 square feet. They blend their own wines on site and then create wine clubs and things of that nature. Lab testing companies, Prudential Wealth Management, local office in the Westlake Village area.
That's great. What a diverse clientele. And so bringing us back to our format, our show, which is cash flow. and real cash flow, generating that residual cash flow through commercial real estate. Now, primarily, we've discussed real estate investment trusts, syndication, multifamily. We haven't gone too deep into office, but we will coming up here. We're going to have a special guest by the name of Nick Bonner join us for future episodes. But Lloyd, with you, I wanted to specifically talk about retail and the franchise opportunity because one of the most profound ways to generate cash flow is to own the real estate itself, but then also own the business. So you've got double cash flow coming in, and potentially you could be leasing from yourself. In a dream scenario, you are a franchise holder of a very valuable growing franchise, and you're starting to buy the assets, buy the buildings. So in essence, the franchise is leasing from you, and you're collecting rent from the profits of the franchise, from the business. In addition, you have other spaces that you can lease to other businesses, and you're just compounding that cash flow. Now, I know it's very rare for owners to own their own real estate, but have you seen that scenario? Have you represented people that are able to purchase their own building, in addition, put their own business in that building?
Yes, there have. Yeah, there's been. In fact, I'm working with one right now on the winery concept. They're looking to um, buy some location in their town rather than lease it, and so the private party, the person who signed the franchise agreement, they will own the property, and then their business, the franchise itself, will lease it back from them. So it'll be a trust, be put in the name of a trust for the family, and then the business will be separate, and we'll do it that way. And most of my representation though is leasing. That's because they're small businesses, anywhere from 500 to $1 million a year in revenue.
Yeah, and that's the owner operator model that we just described. My encouragement for individuals that own businesses that desire to find their own building is take a look at the SBA programs. There's incredible loan opportunities for businesses through the SBA that are specialized for businesses that want to own their own real estate. And if you look at stocks like McDonald's, for example, McDonald's is a brand that's been around, for so long. But what people don't realize is the underlying value of McDonald's is the hard corners that they own. They own a tremendous amount of real estate. And yes, there's some sites that they lease and so on and so forth, but the fact that they've been able to own this real estate for so long has just contributed to the value of the company, the dividends, etc. So switching gears, Lloyd, let's dive more into where is this commercial real estate market headed? As we know, the values of commercial real estate are predicated on cap rates. And when cap rates rise, traditionally values come down. And when cap rates go down, values go up. So it's very much like a bond. Now, what we've seen over these last few years with the aggressive hikes by the Federal Reserve is that the cap rates had to go up to keep up with the overnight rate that the banks were able to borrow at. Meaning, if I can park my money in the bank and get 5% for doing nothing, why would I want to buy a building that only yields 3 or 4%? It doesn't make sense. If I've got to work with tenants and repairs and leasing, I expect to get a better rate on return than I could by just parking my money in the bank. That's the simplest way to understand why cap rates adjust and their relation to the Fed rate or the overnight rate that the banks borrow and lend at. So, what do you anticipate now with a new president in office who obviously is going to be making policies that are going to drive the economy? We have a Federal Reserve who's come out and said, we are reversing course. And when they do that, they don't just do it for 1 or 2 rate cuts. Traditionally, they do that for anywhere between 6 to 18 rate cuts. And it's about a year to a year and a half. And they try to keep those policies moving in one direction. Do you forecast a full recovery in 2025 or 2026? Or what are some other potential headwinds that could stall out the potential recovery in commercial real estate?
Well, the full recovery, I don't have a crystal ball, so I'm going to back off on that one. And but I do think reading the news, looking at Trump what he did the last time he was in our economy. I look for a lot of changes, especially in office is going to change because of AI. In San Francisco, of course, in the Silicon Hub up there. That's where the biggest growth is coming. Industrial, Amazon is out there creating new locations in order to help their delivery and cut costs in delivery. So you're going to see Amazon play a big part in industrial and retail. You know, it's interesting. Retail has, even through the pandemic, was the least affected. You see a lot of signs up, and you hear all about people going out of business, and you know you even hear it now. A lot of places are closing, but what closing really means is they're just realigning and readjusting to start over again. And the retail, with these places like Bed Bath and Beyond closing and a few other places, that's just backfilling vacancies that were really low for the last couple of years anyway. So we're going to see that retail is going to continue to be strong. Rates in retail haven't taken any big hit that I've been. That's where I've been predominant in my business. I haven't seen any really big hits of them going down. Uh, During the pandemic and even still recently, uh, bigger companies are giving more landlord concessions to a transaction, and so that's where you see the effect of the economy more so in the rates themselves.
Yeah, let's talk about some of the ways that market participants, our listeners, can play the market, meaning what can they do in order to profit from the recovery? Now, internally, we are launching a real estate investment trust. That's our answer to take advantage of these discounted prices before they recover. But you may be more comfortable with stock investing in the stock market. And an interesting aberration happened in the stock market this week. When Trump was elected, the stock market in general boomed. I mean, all the indexes went nuts. The Russell 2000 went up something almost like 6%. For an index to go up 6% is a very, very rare day in the markets. But ironically, because the markets went up so much, bonds did the opposite, right? People are typically pulling money out of bonds to put them into stocks or pulling money out of stocks to put them into bonds. And so when those bond yields went up and bond rates or the bond investments were coming down, well, the real estate stocks you would have thought would have boomed with everybody else. They didn't. As a matter of fact, most real estate stocks fell 5% or more the day that Trump was elected, the following morning when the stock market boomed. And I believe that's simply because of the bond market. People look at the bond market for direction on the real estate companies. If rates are going up, well, then that's going to hurt the underlying stocks of the commercial and residential real estate market. Now, if you are a home gamer and you are out there looking for what stocks to buy or what to analyze, potential investments on this recovery, I'll give you some tickers. On the commercial side, you've got CBRE, JLL, CIGI, and that's for Colliers International, CWK, that's for Cushman and Wakefield, NMRK, that's Newmark, and MMI, which is Marcus and Millichap. So there's 6 or 7 firms that you can take a look at. Most of them do participate in the office space and are fully diversified. They're participating in all the different types, but you could take a look and do your own analysis. On the residential side, there's a handful of stocks as well. HOUS, that's Anywhere Real Estate, formerly known as Realogy. There's Compass, COMP. There's another company, EXPI, called EXP. There's RMAX, Remax. And there's a few technology companies, right? There's Redfin, RDFN, there's Zillow, ticker Z, and you can do your research. There's a handful of other micro caps that are out there. But the bottom line is that the last time that Trump was in office, we saw a tremendous run. And if you look from 2016 to 2020, many of these stocks did benefit tremendously from those policies. And so you can take a look and choose which ones you might want to participate in. Any closing thoughts, Lloyd, as far as what you would forecast or what you would direct somebody who's considering investing in the commercial space? What's the right play today? How do they participate if they're a home gamer or what we like to call an armchair investor?
Well, you made the point earlier about investing in where do you put your money if it's 5% in a CD or 5% or 5% cap in real estate property. You need to go beyond the cap because there's depreciation, and it all depends on how the investment is analyzed. Are they just presenting it as a pro forma or an actual performance at a 5% cap, and not considering depreciation in your own personal tax place, and also appreciation depending on what the market is. But it's so different when you invest as to what your personal game plan is. And we talked about the rates are going up because bonds are going up, and interest rates are tied to the bonds. And there's a lot of speculation that with this new president, there's going to be an increase in our debt because we're going to do a lot of spending at the government. Well, that's also going to affect the interest rates because that's what the bond market's tied to. Simple answer to your question is it really depends on where you want to where you want to how where you want to invest that's comfortable to you because of your knowledge of an industry, whether it's industrial or multifamily or retail. If you want to do work, if you don't want to do work, if you want to buy what's called credit coupon clippers or a credit tenant, like a McDonald's who or is leasing a space from somebody for 20 years and all you do is collect a check. That's certainly the easiest and simplest way.
Yeah, very well said. And each individual and each investor's situation is different. For example, if you have a ton of income, extra income, let's say you're a W-2 employee, well paid, and you need those write-offs to basically offset all that ordinary income that you're receiving. Well, that's where real estate is a very interesting investment because of the depreciation factor and the fact that whether you're investing in a syndication or a real estate investment trust, whether you get a K1 or a 1099, there is opportunities for that to flow through to your personal tax return and to minimize those taxes. So the other points you brought up, I was referring to cash on cash when you're investing, when we're looking at cap rates versus what you can get in the bank and a CD, so on and so forth. But to Lloyd's point, you really have to take a look at the pro forma of the offering, meaning are they factoring in the potential appreciation? Are they factoring in the potential value add or the increase in rents that could be obtained by doing some renovation? And what's the debt look like? Because I like to think cash on cash. I know if I buy something that works cash on cash, well, if I add leverage, it's only going to get better versus a lot of offerings out there. And this is a warning to the wise who are out there doing their due diligence on commercial real estate investments. There's a lot of smoke and mirrors within those offering memorandums if you have brokers that don't necessarily paint the true picture. And what I mean by that is they put cap rates or projections or pro formas out there that are based on speculation of what could be in the marketplace. And they're already factoring in the debt, really squeezing the lemon to try to demonstrate the way that you might get a 6 or a 7% cap that looks very, very attractive. But my encouragement is simply to do your own analysis, your own pro forma. It's great to have those offering memorandums that you receive from the listing broker that gives you some numbers. I would always validate those numbers are accurate and up to date because what I've noticed a lot of times is, especially with properties sitting on the market, is those numbers are 6 months old. And if there's an asset that is has high vacancy or has something wrong with the asset and declining revenue, well, you need to know what's happening in the last 30 days so that you can see if those numbers that were put in the brochure a few months ago still hold up and are still valid. So any other recommendations that you can give, Lloyd, as people are out there, they're looking for places to park their money. The stock market's had an incredible run these last few years. In the event that this AI thing cools down, the NASDAQ cools down, and the markets just take a breather. I mean, even if they took a 10, 20% breather, they'd still be so far up over this last decade. And whenever we see those situations, we see people pouring into real estate, which is good for our industry, good for our organizations. But what advice can you give as people are sorting through those OMs, those offering memorandums, and looking at projections?
First thing would be understand the difference between a pro forma on the cap or an actual, like you had said. Make sure they're not trying to sell you have you pay for the upside. When you get a pro forma in there, the smoke and mirrors usually is the other side presenting, well, if you put this tenant in or you do these renovations, you'll get this great high cap. Well, you don't want to pay for work you have to do. So know your numbers. Get the evaluation of the property accurate and well founded. If you can't do it yourself, get a CPA to help you, or get your real estate professional to help you.
Amen. Great advice. Well, we're also joined in the studio by Gary Giffen. Gary, as we wrap up today's episode, I did want to hear from you. Any thoughts, comments on the commercial space? I know you and Lloyd have spent a lot of time and work together. What do you see out there in the marketplace?
Yeah, as a matter of fact, I was just talking to Lloyd about that. We've got a client here in San Diego, and they're trying to decide whether, because they've got some growth, whether to call in and have their team come in and work in the office more, which means that they would have to expand and find a new space, which they'll have to anyway, because their lease is coming due. But whether they can make their people come back in is the key. And I was just talking to Lloyd about that. And Lloyd, you might want to discuss here just before we sign off about how some of these companies are requiring their executives and employees to come back in to the office and not work from home.
There are. I mentioned Amazon earlier. American Express is another one. My son works for them, and they were working 5 days a week out, and they've now bringing them back in 3 out of the 5 days to work in the office. So there's a real good chance that even that American Express is going to go to a full 5 day, and it's a trend throughout the nation. There's a benefit to camaraderie and talking at the water cooler, so to speak, as well as productivity.
Exactly. And that's a key word in my mind. I'm sure the productivity has gone down. Changing a behavioral pattern that was set forth during the pandemic has proven to be very challenging because people got comfortable. Like, if I don't have to go to the office, I'm not going to go to the office. And they had to come to the conclusion that they finally have. And I think Tesla was probably the first one. I remember Elon Musk simply saying, you want to work here? Then come to work. You don't want to work here? Then quit and go find another job. It's real simple. And I'm glad to see that others are following that lead because at the end of the day, if you're in your pajamas and trying to do Zoom meetings and, being distracted by every little thing around your house, there's no way you can be as productive as you would be in a collaborative office space working with peers. So I believe it's a good thing for the nation and it will strengthen the economy long term. Well, Lloyd, I wanted to thank you for being here. I hope that you will come back on and be a frequent guest because you bring so much knowledge, and I'm sure the listeners appreciate that depth of wisdom. And Gary, again, thank you for participating. And for the listeners out there, this is the time. Commercial real estate has been on sale. I don't know how long it's going to last. We don't have that crystal ball, but we do know it's a very rare period of time when you can go and buy some commercial real estate at a discount. So we hope the message has blessed you, and we'll catch you on the next episode.